At the dawn of the 2020s, a three-letter acronym took over the boardrooms of Wall Street and the halls of global power. ESG, Environmental, Social, and Governance. It was marketed as the ultimate evolution of capitalism, a way for investors to save the planet and promote social justice while still turning a massive profit. By 2021, ESG-related assets were projected to hit a staggering $30 trillion, more than a third of all globally managed assets. But beneath the glossy sustainability reports and the high-minded rhetoric, a massive blunder was forming. The financial world had committed to a framework that was fundamentally ill-defined, prone to manipulation, and destined to spark a global political firestorm. The blunder began with the illusion of objectivity. ESG was presented as a set of rigorous data points that could measure a company's goodness just as accurately as a balance sheet measures its profit. However, unlike traditional accounting, there was no global standard for ESG. Three different rating agencies could give the same company three completely different scores. A tobacco company might score high on environmental because of its water usage policies, while a solar panel manufacturer might score low on social because of labor issues in its supply chain. This lack of consistency turned ESG into a choose-your-own-adventure for corporate marketers, leading to a wave of greenwashing, where companies spent more on advertising their virtues than actually implementing them. This lack of clarity created a massive misalignment of incentives. Asset managers like BlackRock and Vanguard began pushing companies to adopt ESG goals, arguing that purpose-driven companies were more resilient. However, for many CEOs, ESG became a convenient shield. If profits were down, they could point to their high ESG scores as proof of their long-term value. Governance, the G in ESG, was often the first victim. Boards became so focused on social messaging that they neglected their primary duty, overseeing the management and ensuring the financial health of the corporation. The governance pillar, meant to prevent corruption and mismanagement, was ironically hollowed out by the very movement that championed it. The financial blunder was the belief that doing good and doing well would always be perfectly correlated. During the era of low interest rates and a tech-driven bull market, this theory seemed to hold up because the tech giants that dominated ESG funds were already booming. But when the global economy shifted, when energy prices spiked due to geopolitical conflict and interest rates rose, the ESG premium vanished. Investors suddenly realized they were paying high fees for funds that were underweight in essential sectors like energy and defense, sectors that were now outperforming the virtuous ones. The rise of ESG wasn't just a trend, it was a trillion-dollar bet on a specific version of the future. The blunder was assuming that the entire world, consumers, voters, and regulators, would move in a straight line toward this vision without resistance. By trying to turn the financial system into a tool for social engineering, Wall Street unintentionally created a massive target on its back. Act 1 saw the birth of the virtue economy. Act 2 will detail the moment the marketing met the reality of the pump, the mine, and the courtroom. Please subscribe if you're enjoying our content. As trillions flowed into ESG-labeled funds, the pressure on corporations to look green at any cost led to the movement's most public embarrassment: greenwashing. This wasn't just a marketing blunder, it was a systemic failure of honesty. Companies realized that a high ESG score could lower their cost of capital and attract a new wave of investors, leading many to exaggerate their environmental credentials. The most high-profile explosion of this bubble occurred at DWS, the asset management arm of Deutsche Bank. In 2022, German authorities raided their offices following allegations that the firm had fundamentally misrepresented the extent to which it used ESG criteria in its investment decisions. This raid sent a shockwave through Wall Street, proving that the virtue being sold was often just a paper-thin veneer. The blunder of greenwashing was facilitated by the rating agency chaos. Because there were no legal consequences for a vague sustainability report, companies could cherry-pick data. A fast fashion giant could be rated highly for using recycled hangers while ignoring the massive carbon footprint of its global supply chain and labor practices. This created a race to the bottom for integrity, where the companies that spent the most on PR often received better scores than those making genuine, difficult structural changes. For investors, this meant the ESG label became increasingly meaningless, leading to a profound sense of betrayal when the reality of these portfolios was exposed. The ultimate reality check for ESG, however, came from the 2022 global energy crisis. For years, ESG advocates argued that divesting from fossil fuels was not only moral, but also financially superior. But when geopolitical tensions spiked and energy prices soared, the virtuous funds, which were heavily overweight in tech and underweight in energy, saw their performance collapse. Meanwhile, sinful stocks like oil, gas, and defense companies were the only ones providing significant returns. Investors who were told that ESG was a risk-free way to beat the market were suddenly faced with massive double-digit losses, proving that ESG was not an alpha generator, but a sector bet on growth in tech that had finally run out of steam. This performance crash exposed the core intellectual blunder of the movement: the idea that social values could override market cycles. By systematically discouraging investment in traditional energy, ESG funds inadvertently contributed to the very supply shortages that made those energy stocks so profitable for everyone else. The S and E goals were suddenly in direct conflict with the P for profit. As pension funds and retail investors watched their savings dwindle, the tolerance for virtue signaling evaporated. The era of blind faith in ESG ratings ended, replaced by a harsh, data-driven skepticism that questioned whether these funds were ever about the planet or just about the high management fees they commanded. The crash of 2022 didn't just hurt wallets, it broke the narrative. The blunder was claiming that ESG was a win-win for everyone. In reality, it was a complex set of trade-offs that Wall Street had failed to explain or manage. As the performance gap widened, the backlash began to move from the financial spreadsheets into the political arena. The identity crisis was about to become a full-scale war. By 2023, the ESG movement faced a new and formidable opponent: a coordinated political and legal backlash. What began as a boardroom trend became a central flashpoint in the global culture wars. In the United States, several state governments, led by Florida and Texas, launched a counteroffensive, accusing major asset managers of woke capitalism. The blunder of the financial elite was underestimating the populist reaction to their perceived social engineering. These states argued that by prioritizing environmental and social goals over pure financial returns, asset managers were violating their fiduciary duty to pensioners and taxpayers. This wasn't just rhetoric, it was a financial divorce. State treasurers began pulling billions of dollars in state pension funds and treasury accounts away from firms like BlackRock, citing their ESG policies as harmful to the local economies, particularly in states dependent on the oil and gas industries. This forced a massive public retreat. Larry Fink, the CEO of BlackRock, and once the most vocal champion of ESG, eventually admitted that the term had become entirely weaponized, and he stopped using the acronym altogether in his annual letters. The blunder was so severe that it forced the world's largest asset manager to fundamentally rebrand its entire investment philosophy to survive the political heat. The backlash also moved into the courtroom. Legal experts and state attorneys general began investigating whether ESG-aligned investment practices constituted antitrust violations. They argued that when groups of banks or insurers collaborated to set climate targets, such as net zero alliances, they were effectively forming climate cartels to restrict credit to legal, productive industries. This legal pressure caused several major insurance companies and banks to quietly exit these international climate alliances, fearing massive litigation and regulatory fines. The governance pillar of ESG, meant to ensure stability, was now the very thing putting these companies in legal jeopardy. Furthermore, the debate shifted to the fundamental definition of fiduciary duty. For over a century, the law was clear. An investment manager's only job was to maximize returns for the client. The ESG blunder was the attempt to expand this duty to include stakeholders: the planet, the community, and employees. While noble in theory, this expansion created a legal vacuum where managers could justify almost any decision, regardless of its financial outcome. As courts began to push back, reasserting the primacy of the shareholder-first model, the trillion-dollar ESG industry found itself on shaky legal ground, facing a wave of class-action lawsuits from disgruntled investors who felt their money was being used for political activism rather than wealth creation. The political backlash proved that you cannot fundamentally change the rules of capitalism from the top down without a democratic mandate. By bypassing voters and using the power of the purse to drive social change, Wall Street had overstepped its bounds. The result was a fragmented market, where ESG became a toxic brand in half the country, forcing financial institutions to operate in a state of constant, expensive defensive maneuvering. The trillion-dollar identity crisis had reached its peak. The movement was now fighting for its legal life. As the dust settles from the political and legal explosions of the early 2020s, the ESG movement hasn't disappeared, but it has been forced into a humiliating and expensive retreat. The acronym ESG is being scrubbed from marketing brochures and replaced with more conservative-sounding terms like energy transition, total shareholder return, or simply risk management. This rebranding is the final admission of the blunder. The realization that the virtue economy was built on a foundation of marketing hype that could not withstand a high-interest rate world. The identity crisis has ended with a return to the mean, a world where capital once again prioritizes profit over ideology. The ultimate cost of the ESG blunder is measured in billions of dollars in lost returns and wasted fees. For a decade, retail investors were channeled into ESG funds that often carried higher management fees than traditional index funds, under the promise of doing well by doing good. However, many of these funds essentially mirrored the S&P 500, but with a heavy, expensive tilt towards Silicon Valley. When the tech bubble burst and energy surged, millions of everyday savers paid the price for this lack of diversification. This wealth destruction is the silent legacy of the ESG era, a massive transfer of wealth from hopeful investors to the marketing departments of global asset managers. Beyond the financial losses, the ESG backlash has left the corporate world in a state of strategic paralysis. Companies are now caught in a double bind. They face pressure from activists and international regulators to meet climate targets, while simultaneously facing lawsuits and boycotts if they move too fast or too vocally. This has led to a phenomenon known as greenhushing, where companies continue to work on sustainability goals but refuse to talk about them publicly for fear of becoming a political target. The blunder of making ESG a public-facing PR tool has backfired so spectacularly that transparency, the very thing the governance pillar was supposed to promote, has been severely damaged. The fundamental lesson of the ESG era is a reminder of market gravity. You cannot social engineer the global economy through the investment portfolios of the middle class without a clear democratic mandate and consistent, transparent data. The attempt to bypass the messy process of legislation and regulation by using Wall Street as a shortcut to save the planet was an act of profound hubris. It assumed that a few powerful fund managers could decide the social and environmental priorities of the world. As it turns out, the world and the market had other ideas. However, the underlying issues that ESG sought to address, climate risk, supply chain ethics, and corporate corruption, remain as real as ever. The tragedy of the ESG blunder is that by overpromising and underdelivering, the movement has discredited the very goals it championed. It has made genuine sustainability efforts look like a scam to a large portion of the public, making the necessary transition to a cleaner economy even more difficult and politically charged. The trillion-dollar identity crisis didn't just lose money, it lost time. In the final analysis, the ESG backlash marks the end of an era of financial romanticism. The billion-dollar blunder here was the belief that capitalism could be transformed into a charitable endeavor without sacrificing its core engine: the pursuit of profit. As we move forward, the S and the E will likely be folded back into traditional risk analysis, treated not as moral imperatives but as standard business variables. The virtue economy has been liquidated, replaced by a colder, more pragmatic reality. The era of the blank check for goodness is over, proving once again that in the world of high finance, If you can't measure the value, you're eventually going to pay the price. Like and subscribe if you enjoyed this video. See you next time, and thank you for exploring the world of billion-dollar blunders with us.